Well, Boeing laid off more than 6,700 U.S. employees earlier this week, and the inventory is piling up. Our next guest says that demand may lag. So for that discussion and so much more, Michael Jones is with us, founder, CEO of Caravel Concepts. Nice to see you, Michael. Thank you so much for joining us. We started off with the Boeing chat. I mean, it is a big mover in the Dow Jones Industrial Average. It really leads the market one way or another in many days. What is your thought on this great American company?
Well, first, I want to make sure that we don't do individual stock analysis. So I don't want to say I know how much of this bad news is priced into the stock already. But, they have $80 billion worth of inventory right now. So they've got a lot of unsold planes that they need to move. Contrast that with where they were going into the last recession back in 2007, 2008. They had $8 billion in inventory. So they have 10 times the inventory. At their current rate of sales, they could theoretically not make another plane for a year and still be able to meet all of their demand with existing inventory. That, to me, is alarming in terms of the amount of financial risk that they've piled onto their balance sheet. And probably more importantly, as you noted, Boeing is a linchpin for American manufacturing. And so if Boeing has that much inventory, that means there's going to be a lot of orders that are not going to be going out to Boeing suppliers. There's a lot of dependencies in the entire manufacturing space. And I think this is a headwind to the ultimate recovery of the U.S. manufacturing space that not enough people are focused on.
I see. All right. So that is very interesting to see that being tenfold of having just so much inventory on hand. Let's talk about the U.S. economy. I know that you said that you're betting, America's betting big on the vaccines, right? So the reopening, COVID-19 infection rates are down, what, about 30% from the peak rates? I mean, what are you watching most closely
Correct.
when it comes to that?
Well, I think, as you noted, COVID-19 has peaked. It's down about 30%. But contrast that with where our friends in Europe are, where COVID-19 infection rates are down 85, 90%. We're reopening, Europe is reopening, but it would appear that the U.S. is taking a much bigger risk of a secondary wave of infections since our infections are not down nearly as much as they are in some of the other folks around the world. What that suggests to me is that particularly in light of how Americans have not been super disciplined so far in terms of adhering to social distancing, wearing masks when they go to the beach, it kind of looks like Americans are ready to enjoy their summer without worrying about COVID-19. So when you think about our infection rates are not down as much as some other countries, when you look at the kind of lax way that we're enforcing social distancing in a lot of places that are reopening, it seems like we're taking a risk of a second wave. And since the market doesn't seem concerned, the implicit bet that is being made both by politicians as we reopen and by investors as we continue to push equity prices higher is that there will be a vaccine ready soon enough that if there is a second wave of infections, investors and consumers will look past that secondary wave of infections because they see that vaccine solution imminently arriving on the horizon. Now, that's not a horrible bet when you look at the amount of vaccine trials that are queued up. We are doing an unprecedented collaborative vaccine testing regime starting in July. 150,000 volunteers are signed up to help expedite vaccine approvals. So having a vaccine by year end is not necessarily a bad bet, but investors need to recognize that's the bet we're making. Bad news on the vaccine will cause pullbacks. Good news will allow us to keep pushing higher.
Right. And, I wanted to get your attention over to General Electric. Obviously, a huge company just exited the light bulb business. They're talking about aviation likely to ding the cash flow is what the market chatter is from Barron's. What are your thoughts on General Electric? I know you have some.
Well, in terms of the stock, like I said, we don't do individual stock analysis, but in terms of the impact on overall growth, GE, if you look at the top 10 manufacturers in the United States. It's a bunch of energy companies, Boeing and GE. And in the case of GE, they have a tremendous amount of exposure to Boeing. They are a big engine supplier to Boeing, and they have a big exposure to the energy space. My personal opinion is that our frackers cannot compete with Russian and Saudi Arabian cost of production if oil stays in the $30 to $40 range, which we think is likely. And that you've already seen rig counts plummet, and that means jobs are going to be plummeting, and a lot of business that could normally go GE's way as a part of their energy business, it's not going to happen. So I do think GE is another one of those potential victims of the problems that are plaguing the aerospace and the energy space. GE's right in the crosshairs of that, and it's another headwind to U.S. manufacturing recovery.
All right. Michael Jones, thank you so much. Founder, CEO, Caravel Concepts. Thank you. Good conversation.